I want to thank you for coming. I know the 30th in the middle of a bowl game and with all sorts of different things going on. Today is not the day that a lot of people are thinking, oh, you know what I'm going to do is go sit through a webinar with Mark and the guys at Option Pit. But I'm going to do everything I can to try and make this worth your time. And, you know, I hope everybody really enjoys the webinar. So what is Option Pit? We are a full-service education firm. We do education for individual retail investors. We have a chat room for individual retail investors. We also do some pretty heavy consulting work with hedge funds and different groups like that, RIAs. We do a lot of work helping them implement option strategies. And then, of course, you know, the thing I like to say that differentiates Option Pit from every other group out there is we are traders who consult and educate. We are not educators, and that is what we consider to be our big differentiator. I am the priest of options education, option educational outlet. I don't know about that. That seems a little sacrilege for me, but I'll take it. All right, so with that, let's get down to business. And if you got questions about this, you can email me, mark@optionpit.com afterwards. This will be recorded. I will push an email out to everybody, all right, with the recording. So with that, let's talk about the Option Pit monthly webinar, the Option Pit method, options for stock traders. So if you are already a super active option trader doing all sorts of stuff, there'll be some interesting things on VIX, I think, at the end, but the beginning of this might be a little slow for you. But stick around. I'm going to talk about some VIX stuff. All right, so the problem. Trading stocks is margin intensive. All right, it's really hard to trade stocks with a small account because they require so much margin. All right, and investing in stocks ties up lots of capital. All right, you know, one of the things that people like to say is, oh, you should diversify. Well, if I've got a small account, it's hard to diversify, except for through something like the Select Sector Spiders or SPY, and those charge fees. And really, other than getting broad market exposure, you know, it's very difficult even to diversify with a small account. The market can lead stocks one way or the other. It can be hard to tell which way the stock market is going throughout the day. So that's just it. You know, you're trading stocks, and you think you know that a stock is going up, but then the market does something and it pushes the stock in the wrong direction, one way or the other. All right, so we're going to talk a little bit about maybe how you can tell what the market's going to do in the near term over a couple of days, a la swing trading, or in the immediate, a la day trading. All right. So what are you going to learn? How are options and stock related? We're going to talk about replacing stock in day and swing trading, replacing stock in some investing strategies, and an indicator we use to analyze the SPX here at Option Pit. All right, stock and options. Options are derivative of stocks. Now, they're often called derivatives. All right, and all of the word, and it sounds fancy. It really does. But all derivative means is of something else, right? Like, you know, of something and related to something else. So an S&P 500 future is a derivative of the S&P 500 cash market. All right? So options are just an instrument that is related to the price movement of the stock they're an option on. All right? That means that, generally speaking, for an option price to move, the underlying price must move as well. Now, there's a lot more to that, all right, that I don't have a bunch of time to get into. But just be aware that an option is going to have a lot of trouble moving very much. All right, I mean, honestly, I've seen options move without the stock price moving. I've seen it happen a lot. There are very specific instances when that happens. All right. But generally speaking, most of the time, except for in specific situations, the underlying price needs to move for the options to move. All right. Then, the next thing is how well one instrument moves with another is called correlation. All right, correlation. All right, so if an instrument moves, if an instrument moves $1 and the other one and the derivative moves $1, they're correlated at 100%. For instance, the S&P 500 future is correlated at almost exactly 100% of the S&P 500 cash market. All right. Options can correlate at any number between -1 and 1. All right, for our purposes. Can an option theoretically get a delta? An American option can theoretically have a slightly higher delta than -1 or 1. But for our intents and purposes, all right, options can correlate at any number between -1 and 1. All right, so delta. All right, for option traders, how well the option correlates to its underlying is called its delta. All right, there are other definitions of delta, but this is the one I want to use, and this is the one I like. All right, thus, options can have a delta of between -1 and 1. All right, options that have a positive delta will move with the underlying. Right? They'll move with the underlying, which means if the underlying goes up, the option will gain in value. If the underlying falls, the option will lose value. All right? Options that have a negative delta will move opposite of the underlying. Essentially, if the underlying goes up in price, the option will go down in price. And if the underlying goes down in price, the option will go up in price. All right? Everyone understand that? All right? So here's an example of delta. All right? Got a few different deltas that you can look at. All right? Now, this delta says 80.86. All right? Now, you may also see that listed as 0.8086. All right? Options, all right, if you buy a one option contract, how many shares of stock does that give the trader the right to buy or sell? You trade one contract. 100, correct. Correct. All right. So the point, so that 0.8 or that 80 that we have there, that 80.86 is literally just the delta of the option times 100. All right, and that represents the total market exposure, a total underlying exposure of one contract. All right. All right, so in this case, this contract has the exposure of a little under 81 shares of stock. This contract theoretically has the exposure of a little under 22 shares of stock. All right, so now let's just be very simple here. The TLT Jan 123 calls have a delta of 80. All right, I know it said closer to 81, but we're just going to use 80. All right, that means if TLT moves higher by $1, the 123 calls will make $80 a contract, or 80 cents the options price. Thus, you see that the theoretical is $3.30. So, theoretically, if TLT rallies $1, the market, the 123 calls will be worth $4.10. The bid will be $4. The ask will be $4.20. if TLT falls by $1, the 123 calls will lose $80 or 80 cents in the options price. All right, thus they'll be worth $2.20 and versus at $2.40. All right, all calls have a positive correlation. All right, so it's the position of the calls that creates an opposite correlation, but calls, the price of a call positively correlates with the underlying. All right, so calls will move with the underlying. They are long delta. All right, so if you buy calls, you are buying delta. If you sell calls, you are selling delta. All right, you buy calls, you are buying exposure. You are buying positive exposure. You sell calls, you are selling positive exposure. All right, so now let's look at puts. All right, here's the TLT Jan 127 put, and you see it's got a 61 delta. All right, so the TLT Jan 127 puts have a negative 61 delta. All right, so for every dollar TLT rallies, the Jan 127 puts will lose $61 or 61 cents in the option. For every dollar TLT falls, the Jan 127 puts will make $61. All right? All puts have a negative correlation to the underlying. All right? Any questions on this? Anybody have any questions on how delta and stock are interrelated and the underlying are interrelated? All right. Doesn't delta change with the strike movement? Yes, it does. All right. That is its second derivative called gamma. All right. But typically, all right, unless the option has a very short time to expire, all right, or is very at the money, gamma will have less of an effect than you realize. All right. But yes, it absolutely does. All right. And that is called gamma. All right, and that is a intense study into the Greeks. All right. So let's talk about how we replace stock. All right. So here's the biggest problem with stock. All right. The minimum overnight Reg T margin on stock is 2 to 1. All right. Now some brokers have much better intraday margin. Some do not. All right. But here's the problem. All right. With the stock market at an all-time high, there are a lot of stocks that are $80, $90, $100 or more. All right. Apple, which is consistently one of the most active traded stocks in the world, is 115 bucks. All right. This means that if I buy 1,000 shares of stock, all right, that are on a $100 stock, the minimum my overnight margin is going to be on a Reg T account is going to be 1,000 times 100 times 0.5. So if I do a short-term swing trade on an expensive stock, I'm putting 50 grand at risk. All right. Now, for some people, that is not a lot of capital. For many people, that is a lot of capital to be putting into a trade. All right. Now, intraday, I've seen margins go 8 to 1. All right. I'm sure that there are groups out there that will let people do that. All right. So that ties up a lot of stock. And futures are great and tie up way less capital. However, the futures have a limited profile of things that one can trade, right? Nobody trades single stock futures, all right? And really the only active equity futures is the S&P 500, the Russell 2000, and then the NASDAQ and the RUT to a lesser extent, the Russell 2000. All right. And there's things like international ones like DAX and some other things like that. But, you know, if you are a stock trader, there's not a lot of ways to trade a stock that you think is going to move over the next couple of days other than the stock unless somebody uses options. So let's talk about how to replace a stock. All right. In buying a heavy delta or a hard delta, I'll sometimes call them, all right, I can replicate the exposure of 1,000 shares of TLT stock using far less capital. All right. For instance, all right, if I buy 13, all right, of the TLT Jan 123 calls, I get a little more than the equivalent of 1,000 delta. All right? So I get a little bit more exposure to the market using the 123 calls than I do buying 1,000 shares of stock. But let's compare the cost. All right, so there's the cost. They cost $3.30, let's say. All right, stock margin, TLT at the time I took this shot was trading 125.77. Times 1,000 times 0.5, the overnight margin is going to be $62,885. The margin on my option is going to be $4,290. Think about that. I've got margin of about 8% of my stock margin. And I'm getting the same exposure. All right? And in fact, you know, if we really dig into this, I'm getting less exposure. I'm getting more exposure on the upside and less exposure on the downside. That's the beauty of options. All right? Now, I don't have time to dig into all that. But for our intents and purposes, I'm getting on 8% of the margin, I'm getting the same exposure. Now, let's say my goal is to make $2 on a day or swing trade. All right, I'm trying to make $2,000. I think TLT is going to 127.77. Let's think about the return on that trade, if I'm right. All right, so if I make $2,000 on 62 grand, what's my return on that? Not bad. I mean, 3% in a day or two is not terrible. The 2,000 is the same. Yeah. All right, but think about what you put at risk. All right, so I make 3% on my dollars at risk. On my second trade with the stock, I make 47% on capital. And I didn't have to put 88,000. I didn't have to put another 58,000 at risk. Now, I don't know about you, but if I had an extra 58,000 bucks, do you think I could find, even one more trade that I could probably make money on? And this is the key, right? I'm doing a swing trade or a day trade or even a longer term trade. All right. So the answer is, yeah, if I could find a second trade and potentially make, let's say that trade's not as good and I make another $1,000 bucks. All right. Well, will I take, there's an opportunity cost associated with tying up those dollars. All right. This is a great question. Please ask me at the end of the webinar because I really want to answer that. Okay? But I don't want to interrupt the flow. By the same token, then if I lose 3% in the first case, about, versus 50% with the options. That is true. That is true. But, the nice thing is, you really, well, in theory, really you won't. But that is true. However, I personally like to think that I win more often than I lose. I typically make or lose about the same. But if I win more often than I lose, all right, then go me. Now, on the flip side, there are some people that are 50-50 traders, but they make more when they win than they lose when they lose. Either way, having the opportunity to get in multiple ways is huge. Well, doesn't that come out to 750% annualized? This is just a random example on one trade. Okay, I don't want to annualize this. I'm really kind of more interested in the dollars at risk versus dollars I can make. The leveraging effect. All right. Really, yeah. Does that make sense? Oh, don't apologize. So invest the same amount per trade. Absolutely. I am a firm believer. We're not going to dig into a lot of the, the real nuts and bolts of managing a position today because I've got, 45, 50 minutes to discuss all this. But what I will say is it is very important to manage your book and to put the right amount at risk on every single trade. All right. But one of the things that using options allows us to do is diversify our exposure because we're not tying up so much capital. The one thing I like, here's kind of a real example I would give you guys, okay? One of the, and I'm going to talk about this, one of the biggest problems that I talk to with swing traders and other people like that is, Mark, I'm right on my swing. I know I'm right on my swing trade because, Facebook outperformed the overall stock market. The problem is, over that 2-week period, the stock market fell, and so my swing trade didn't make a lot of money, but at least I didn't lose because I picked the right stock. That ever happen, anybody? That sound like a familiar story? Yeah, it sounds familiar to a lot of people, right? Well, now if I tie up less capital, what if I find a good swing trade that I want to be short and a good swing trade that I want to be long? All right, and I tie up similar capital. What does that start to do? Anybody? Bueller? Yeah, right. It makes a balance. It starts to remove some of the market exposure. You know, in our strategy letter, one of the things that the reason risk, you know, we don't kill it, but risk adjusted, our strategy letter absolutely torches the stock market. All right. So now, let's talk about how to choose the right option. All right. For stock simulation, the 75 to 80 delta option is typically going to track the stock well enough that one can use it in a day or a swing trade. It also should have enough liquidity that traders are able to get in and out. One thing to be careful of is make sure there's enough open interest. I'll show you this. I thought I cut that out. I did not. So in those January options, you know, if you look at the 123s, there's several thousand open interests. That means there's people watching it and trading it. All right? Some of these half strikes that only have 100 or something like that, certainly if you want to get in and out of something, then definitely look for open interest. I'm not a huge believer in trading open interest. That's kind of one of the few areas where I really do believe it. All right? All right? So it should have enough liquidity that you can get in and out. That 75 delta option is usually about right. Happy New Year. All right. All right. The right option. If one is going to go long, one can buy calls. If one is going to go short, one can buy puts. Or one can add that volatility component in. Now, I have on YouTube a couple of different webinars where I talk about using volatility to trade stock options. All right? I'm not going to dig into that today. But if one adds that second wrinkle, and you can go to our YouTube channel to watch it, all right? And actually, you can go to the page that I'm going to present at the end to watch it. All right? One can add a second wrinkle trading by selling options. All right? So, all right, if volatility is normal or low, look to buy calls or buy puts. But if volatility is high, one can sell a deep put spread or call spread. So basically what one might do is sell the 75 delta put and buy a 5 delta put underneath, and that gives one long exposure to the market. And if one wants short exposure, do the same with a short call. Sell a short in the money call and buy a 5 delta call, and then you'll get that short market exposure. All right, and that'll reduce the margin. All right. Now, I haven't even talked about the fact that doing these option trades, one of the values of having less margin is in a October 2008 type of scenario. The amount purchased at $4,000 is the most that one can lose. So if one just has a couple of trades, and one's well diversified, right? So if I'm long a put in something I think is going down, and long a call in something I think is going up, and then October 2008 happens, I'm going to lose what I paid for my calls on my bull trade, and my downside and my bear trade, the amount of money I can make is not limitless, but really not pretty close to limitless. So I have a copy of that. I'm going to have this webinar, and I'm going to set up a page for this webinar and the using volatility to trade direction webinar on the same page. All right, so now let's talk about long-term investing. All right, in the past, and you can go and see the wheel trade thing that I discussed, I've talked about how short puts and covered calls can enhance the income of stock investors. All right. So any questions on that, by the way, before I dig in here more? We got a lot to cover today. Somebody's saying the audio is harsh. Well, that's probably just me. All right, good. All right. Again, the issue is the margin. The big issue with stock investing for anybody that doesn't have $1 million is the margin associated with owning the stock. All right, and there are multiple ways to do that. All right, so rather than executing a covered call, one can execute a diagonal spread. All right, or a calendar spread. One could buy a long-term option with slightly heavy delta or a hard delta, and then one can sell an out-of-the-money option with a smaller delta against it, a delta in the range of 20 to 30. All right, you can use monthly or weekly. I usually use weeklies. Anybody here watch my show Track the Trade? Time for Track the Trade with Mark Sebastian. All right. Oh, yeah. It's just www.trackthetrade.com if you haven't seen it. All right. So I've got two examples that I've done recently, all right, that have basically been stock replacement. TrackTheTrade.com. It's also on, it's a CBOE TV show. So I film it at the Chicago Board Options Exchange television network, but we then pull it out to TrackTheTrade.com. All right. So this is a TrackTheTrade trade that I am doing. All right. I'm still in it. Both of these trades, actually. So I started by buying to open the Jan 110 call in Apple for $4.50. All right. Against that, I sold the Apple 114 call expiring in December at 75 cents. All right. That call expired worthless. I then went out and sold the D26, so they expired last Friday, right after Christmas, 114 call at 55 cents. All right. That expired worthless. Then, on Monday when I came in, I got to sell the Jan 115 call at 70 cents. So now, you notice the way things were potentially going, if Apple kept this slow rally, I might have been able to sell the 116 or the 117. All right. So in total, I paid $4.50, and I sold $2. $2 in premium. Well, right now my Jan 110 call is worth $3.65. So that's lost what? 95 cents? 85 cents. That's lost 85 cents. And on my $2 in premium that I've sold, I've made $1.91. So on a total margin, the total margin on this trade would have been $450. I'd be up $106. What's the return of, and that would be in 3 weeks. I'll let you guys annualize that. So if I make $106 on $450, all right, and I do that 52 times, divided by 3, annualized, that'll be a 408% return. Not terrible, right? Now, obviously, if Apple had tanked, all right, I wouldn't have been happy. But there actually would have been things I could have done to manage that as well. I've had the stocks can go down. I don't know if you guys know that. But this is a nice, and I could have gone out and bought a longer term option, right? So just looking at Apple, you know, if I wanted to do this with an April option, I'm going to spend more, right? I'm spending $800. All right, and then I could have sold all these different options against it. Now my plan for the balance, I am probably going to shut down. So this is the call I currently have on. I'm short the 115 call. All right, I am probably going to, you know, if we're unchanged or down a little bit tomorrow, I'll probably cover it and then maybe sell the 113. All right, or alternatively, I could move back and sell next week's 114 and 96. I might do that too. All right, so, I mean, not a terrible way to manage things. All right, so now, here's another trade I did on Track the Trade in Facebook. Now, this one was actually a huge pain in my butt. All right, this stock, Facebook, I put this thing on when Facebook was $73 or $72, and it was off to the races ever since. All right, so watch this. So I bought the Jan 75 call for $251. Against it, I sold the Nove 28.75 call at $22. All right, I had to cover that 75 call in November for $2.46. That was a kick in the pants. All right, so then I sold the Dees 5.77 at $132. So right now, I paid $251, but for my Jan 75, but I've lost $2.24. So then I collect $1.32 on my D77s. So now my 224 is, let's see, 124. One is going to be it's going to be 92 cents. So I'm out 92 cents of premium. All right, the next week I sell a call at 80 cents, buy it back for 86. So now I'm out $96 in premium, or $98 in premium. All right, next week I sell the 77.5 call at 130 and buy it back for 245. Not going my way, is it? All right, so I'm now out $2.01. All right. The next week I make 2 cents. Go me. So I'm out $1.99. All right. And then currently I made 30 cents on my trade. So right now I've lost $1.69 selling these near-term options. But my long-term option is up $2.29 or $2.19. So even though I lost $1.69 short on this quote-unquote investment, I still made money, even though I was wrong. All right. Do I have specific rules for entering these? Yes. I'm not going to cover those today. You can find those. The same rules here are the rules that I would call the secrets of covered call trading. All right. Now on Track the Trade, I like to pick stocks like Facebook and Apple because they are very popular, and more people will watch the show. All right, so that is why I don't pick a boring stock like GE, which is probably a better trade for this. All right, so when to execute. This is a great strategy in just about any environment. While IV might be high in back month, it will typically be even higher in the front. Thus, vol distortions will quickly be covered. All right, but do not buy the most expensive month on the board unless it's an earnings month. All right, other conditions. This can be great to buy an earnings month or week. You could sell the front or weekly in front of the purchase. All right, I love doing that. This stock has earnings in the February cycle. I like buying the February cycle and selling a bunch of crap in front of it. All right, should be executed in a stock that one expects to move in the direction but somewhat slower. All right, so I was pretty dead on Apple and pretty wrong on Facebook, and I still managed to make money in Facebook. All right, so now what I'm going to talk about this is for the day traders. All right, the S&P 500 really leads the whole stock market. Everybody knows that. It leads SPY, leads all the broad market indexes. Sometimes RUT will lead ES, all right, and will more or less point the direction many stocks take in the near term. When the ES weakens, so will most stocks, even if the stock is moving in the opposite direction. It's interesting, yeah. You've got a stock that's having a big day. It's up. Even a stock that's really up. All right. If the S&P 500 ticks down a few points, typically it will tick down as well. All right. Everybody here agree, or is there anybody that wants to argue that contention here? No. Good. That's because that would be silly to argue because I'm right. All right, so now, which came first, the chicken or the egg? All right, and in that answer, VIX futures and VXX almost always lead ES and SPY. I mean, it is 80. I would say north of 80% of the time, VIX futures tick before the S&P 500 futures. All right, and the main reason is honestly, it has a smarter trader trading it. Second, it has a huge tick. All right, anybody know what the tick is on an S&P 5 on a VIX future? So if I make it ticks in nickels. So if I make 1 nickel, do you know how much I make on on a VIX future? $50, not $50. Yep, it's a $50 tick. How's that? That's not bad, right? Huge tick. All right, and it leads the S&P 80 to 85% of the time. All right. For those looking for enter and exit points, or they're trading weakness, or they're at a debate, watch the VIX futures along with ES. If you're a person that watches ES to go along with their day trading, I know a lot of day traders that keep a tight watch on the S&P 500 future. The VIX will lead. So this is actually, I pulled this from today. And now you have to be careful because the times don't match up exactly. They do up here, but they don't really back here. But what I want you to notice is if you look at kind of when this huge sell-off took place, a little after 12:30 my time, a little before that, we started to see the VIX future tick up. Caught a secondary tick right there, and that is before this thing fell apart. It will start to move. You will have a good, it is a good 20 seconds ahead. Saw the same thing here. that is an entirely different webinar. I'll address that at the end. But I have a webinar on YouTube on understanding the VIX and VIX futures, and you should watch that. You'll learn a lot. All right. The VIX future trades like on a busy day. On a slow day, trades like 150,000 contracts, and on a busy day, it'll trade 300,000 to 400,000. Who is considered smart money? VIX Cash. VIX Cash doesn't trade. There's no way to trade the VIX Cash. VIX Future. There is again. VIX Futures are where you can trade VIX, and that's where the smart money is. There's no point in watching VIX Cash. You know how often VIX Cash updates? It is an index, so it's every 15 seconds. It does not update dynamically. VIX Cash is driven by SPX options. VIX futures better represent a variance swap than they do the VIX Cash, and that is what the smart money is trading when they're trading VIX futures. All right. Alex asked me that when I'm done here. So that's an example here. Now I'm going to talk about a couple of quick multi-day patterns. Then we'll take questions. All right. So there's two multi-day patterns I like. Whoop. One is the correlation break, and this is when you can use VIX and the S&P. All right. Over multiple days, if the SPX is up and the VIX is flat, slightly down, or slightly up, that is really bullish. We saw this November a while back. All right. So notice this. Here's the part one. Rally in S&P, sell-off in volatility. That's good, right? Well, then we have rally in S&P, no movement in volatility. See that? And actually, a little bit of a rally in volatility. That is bad. Notice what happens to the market. We drop 30 handles. Now I'll show you correlation. So S&P 500 up, volatility does not fall. That is bearish. Now here's an even better one. All right. Over multiple days, if the SPX is down and VIX is flat or down, all right, it is super, super bullish. The market is about to pop. We actually saw this a couple of weeks back when we popped out in October. Or, excuse me, in November. When we popped out in the beginning of December. That's what I meant. But here's another case in November 2011 that I want to show. So here you have it. We got the market selling off. Volatility really isn't doing much. What do we get? We get a rally. All right? Then we get a sell-off, and volatility doesn't do much. So what do you think happened? It was off to the races after this. This pretty much marked the bottom. Using volatility and the volatility price action, I legitimately called the bottom of the market during 2011 on my blog, the Option Pit blog. All right, so in summary, use in-the-money options to simulate stock, use calendars and diagonals to simulate a covered call, and use the VIX as an indicator. Now, real quickly, January 17th, we're bringing back our Saturday class. All right, it's a special Saturday class on using options to trade stock and for actual inter and intraday trading of stock. All right, and what we're going to talk about is how to, we're going to really teach you how to increase those profits relative to dollars risk. I'm going to dig a lot more into VIX and volatility as a trading indicator. We're going to teach you how to make a lot more money trading directionally, so we're going to really dig into some of that volatility. And honestly, we're going to teach you about spreading, credit spreads, debit spreads, really all sorts of stuff. This is, this is going to be a really unique webinar. All right, every one of these is unique content to the webinar. All right, it's going to be 3+ hours recorded. You get to keep it. We normally do it for $147. All right, I'm offering it at $97. Fix that so it says the right number in there. Normally these are $147. I'm doing it at $90. Do that. All right. I've got a limit. So $97 for 3+ hours. And if you enroll by 1/5, so that's next week, and you use code PLANET, it's going to take 21% off. All right. So for 3+ hours of work, let's just say 3. You're getting pretty top-notch education for $79. So, or actually $75. It's a pretty sweet deal, and I would strongly accept you to do it. Will I be teaching the wheel? I'll be talking, we talk about the wheel of the boot camp. I have not constructed the discussion yet, but I might dig into the wheel a little bit, especially with my BXY put right stuff that I've been working. It's going to be in 2015, yes. All right. So we got some questions. All right. Yeah. Oh, it's under here. Just because so here's an interesting thing. So VIX at 16 does not mean. Yeah. You know what? I've not kind of sat down and really, I've talked to Andrew in detail. We're going to dig into some long-term stuff and some short-term stuff. So why don't you shoot me an email and we can talk about it. I went through the wheel in some detail in the boot camp, and if you really want to dig in that, you can buy the replay of the boot camp. This will have some of that, but it's going to be definitely more trader. All right. 888 of the bearing. I don't get that anyway. All right. What about now? VIX up somewhat, but SPX stable. It's interesting. SPX has been. We had a really hard rally, and so the VIX is taking its time to deflate. All right. SPX was down today, and VIX really didn't do that much. And a 16 VIX is historically about normal. Does the beta of the stock measure correlation with the SPX? Assuming that you are running your beta against the SPX. It really depends on what you're benchmarking the stock to. All right. This is going to be, we're going to do a section on long-term trading. I imagine the wheel. Oh, it says Jan 17, 2014. I do mean 2015, yes. Ha! Ha! Well, thank you for pointing that one out. I mean, I don't think, if I can teach this in 2014, that would be incredible, wouldn't it? Imagine how much money I could make on the year. What trading platform are you on and why? I primarily use LiveVol execution. I also use a little bit of Thinkorswim. LiveVol execution has the best analytics for option traders by a curvillion long shot. I wouldn't use VXX to long volatility except for as an intraday trade. If you want to go long volatility, the best way to do it is usually like a VIX future or an option on VIX. Can I watch your lesson on YouTube? Under what name? Yeah, if you Google stuff on YouTube, you can find the you should be able to find the channel. Here, I'll drop in the YouTube channel here. All right, so here's the address to my channel. All right. All right, so now to sign up for the course, real easy. Optionpit.com/stocks. 75 bucks. How do you lose, right? And honestly, if you take the course and you hate it, and you keep the recording, yeah, you keep the recording. I'm gonna send everything. If you hate it that much and you email me and say this is a ripoff, I'll give you your money back, but you're not gonna think it's a ripoff. So optionpit.com/stocks. Yeah, we're going to probably, so the course that we're going to do for the 3 hours, we're going to do a section on longer term and swing trade, then a section on really active trading and spread trading. But the idea is we want you to replace the use of stocks entirely, or to understand how to do that by the time we're done. All right, any other questions? Comments, thoughts? Well, email me, marketoptionpit.com, if you got questions. And how much for the recording with bootcamp? Shoot me an email. I think the recordings are available for $117. And that's a pretty sweet course too. That was almost 8 hours of work, 4-day class. You can sign up for that at optionpit.com/bootcamp. Might be 147, I forget. You know what? I think it's 147. You can use the same code, so it'll be 117. All right. Any other questions, comments, thoughts? So worth your time to skip a bowl game today, or was that terrible? All right. All right. Thanks, everybody. Have a great day. And how many ticks does the VIX futures move in a typical day? Typical range will be 20 to 50 cents. But on a busy day, it can move $3-4 bucks. All right. Cool. All right. Well, hopefully I'll see you all in that Saturday class, and make sure you check out the YouTube channel. I'll shoot the replay of this out tonight. Everybody have a great day.